All right, hi everyone. Very excited to be hosting this event for you guys today. I apologize for the delay in our start. We had a little bit of technical difficulties, but we're glad everyone's here now. So my name is Teason Thompson. I'm a business development associate with the Matchell and Associates Wealth Advisory Group here at National Bank Financial. I've worked in the industry for about 4 years now. Been with Mike at National since last January. And I'm now going to pass things over to Mike, our senior portfolio manager, to introduce a little bit about himself and explain how we help clients.
Perfect. Good afternoon, and thank you, Teason. For those of you who do not know me, my name is Mike Matchell. I'm the lead portfolio manager and wealth advisor at the Matchell and Associates Wealth Advisory Group at National Bank Financial Wealth Management. Just a little bit about our company. Just if any of you are unfamiliar with National Bank, National Bank Financial Wealth Management is a division of National Bank of Canada, which was founded in 1902, and we manage $170 billion of our clients' wealth across Canada. A little bit about myself. I've been a chartered financial planner and wealth advisor for the past 24 years. And our practice and our team focus on helping clients with 4 key areas that we believe are the cornerstone of wealth management: tax planning, investment management, estate planning and wealth preservation, and finally the 4th one, which is financial planning for business owners and pre-retirees. We deliver customized, unique, and thought-out strategies for our clients using the most up-to-date concepts that the market provides. We run a few educational webinars throughout the year for clients and centers of influence, and are excited today to have Matt Trotta, who is a tax and succession lawyer with CI Global Asset Management. He works in their retirement and estate planning services department and has a vast knowledge of everything related to tax and estate planning. The title of today's webinar is Business Succession Planning: Maximize, Minimize Taxes, and Secure Your Future. We hope that you come away with more knowledge around succession planning than you came into the webinar with. There should be an option, as I understand it, for questions at the end of the presentation, but I believe you can, Teason, you might be able to better answer this, but I believe you'd be able to put your questions in during, but I'll let Matt discuss this a little bit further. I'll now hand this presentation over to Matt.
All right, well, thank you very much. Great to have all of you come out this morning. So what I'm going to do now is just bring up the slide deck here. So hopefully you all see this. As mentioned, what I'm going to be doing today is going over some tax and succession planning thought processes that go through throughout the life cycle of a business, and issues that are specific to owner managers. So as mentioned, it's probably going to be best if we have all the questions at the end, but if they're aggregated throughout the presentation, I'll be happy to go through that. So what we're going to discuss today is going to be business succession planning on a large scale. Then from there, we're going to talk about the transition of the business, sale of the business, and estate planning issues for an owner manager in particular. Since estate planning is quite nuanced, there are going to be particular issues of note for business owners. So we'll first start off with business succession planning. So in many cases with business succession planning, at some point in the process, no matter how advanced or how basic we're looking at with a corporate structure, we'll probably have at some point in the life cycle of a business an estate freeze. And so here's an example of what an estate freeze often will look like for a family business owner. This is in a situation where they're not quite ready for retirement, but this is around the time we want to start thinking about structuring for retirement. So in our hypothetical situation, we have a founder, age 58, married with 3 children, has relatively basic common shares of a corporation that he acquired at nominal ACB. So essentially, this would be the situation where we subscribed for shares at $1 a share, give or take. And we've had a significant rise with the fair market value now around $4 million. He's getting ready to retire, but he still has several years left of which he wants to have some control over the succession of his business. So what we would do in an estate freeze type situation is we would take these common shares, and what we would do is we would convert them into preferred shares at a fixed value. So instead of having 100 common shares worth 4 million, we might have 4 million preferred shares worth $1 a share, or we might use a smaller number depending on what the planning is. But essentially, the idea is we have now frozen the value of the corporation. So any new shares would have to be at a nominal value as well, because the corporation's worth 4 million. There's already 4 million in fixed value shares. This is where, in many cases, we would bring in new shareholders to buy common growth shares. Depending on the family structure, in this case, we're going to bring in a family trust. Why do we do that? Because this person's not ready to retire. We want flexibility and we want to consider the future. So what we'd have is a trust that's set up with an unrelated third party as a seller. This is very important to prevent attribution rules coming into place and negating all the benefits of this type of planning. In this situation, we have the trustees being the founder and their spouse, because again, the founder wants to maintain a level of control. And then we also want to have an independent trustee, whether this is the family lawyer, accountant, third party. We want to have somebody who's independent of this, because this allows some flexibility in the future in case there's an event of marital breakdown or anything of that nature, that the independent trustee can run this in the interests of the beneficiaries who may be at odds with each other. In this situation, we've got a founder, spouse, children, and potentially a holdco as a beneficiary of this trust. Whether or not we want to use the holdco, how we can use the holdco is really going to depend on the situation. We'd want to have on a case-by-case specific advice on that, but this is what we're doing here. So what would we achieve from this type of process? Well, as mentioned, the founder maintains control of OpCo. Founder has 4 million to redeem at their option because those shares are now fixed in value. Now, it's important to note if we redeem at option, they may be at a deemed dividend rate. So we want to be mindful of how we do that. Is there a CDA balance? Or, how do we want to deal with that over time? The important thing is we've now crystallized also what his capital gain will be, or what his gain will be at death, rather. We know it's 4 million. That's the tax hit we're looking at. We've now have the future growth going somewhere else. So these trust beneficiaries can now enjoy that future growth. Income can be controlled. We don't have to necessarily give everything out to the beneficiaries in any given year or any particular beneficiary if it's a true discretionary trust. And this provides a lot of flexibility, since the children may or may not want to be the people who take over the company. They may not be the ideal people to take over the company because we may want to sell it. And because we control that distribution, we also want to be mindful of changes in marital status, things of that nature. What's also really important here to note, though, is anything we don't pay out if there's income to the trust will be taxed at the trust rate, which is the highest marginal rate in Manitoba. So why would we do an estate freeze? Kind of pulling back from this more broadly from our case example. Well, an estate freeze has that option of tax deferral and tax minimization. We've now frozen the value of these shares. We know what they're going to be worth at death. So we can now, minimize our tax going forward. It gives us an option on how we want to go forward. We can now income split with our family members, bearing in mind that TOSI could easily apply depending on what the source of revenue is here. But there are a significant amount of TOSI safe harbors. There are some planning options out there that are usable at a case by case. So we need to be mindful of this, but we now have that potential depending on what the future of this corporation may be. We have the ability to now transfer growth shares to children or other family members or key employees as we see fit, depending on if they're beneficiaries. This gives, in that trust option and in a general option, we may have employees buying in at a nominal rate instead of having them get involved in something more complicated like an employee ownership trust or something of that nature. With the estate freeze, we now have the ability to bring in new shareholders at nominal rate, and with that growth, we may be able to multiply the lifetime capital gains exemption on a third-party sale, which I'll explore a little further. The last reason is probate minimization, which is not a significant factor in Alberta or Manitoba for that matter, because Manitoba has pretty much no probate tax, and Alberta has a very nominal one at $525, whether you're dealing with a $250,000 estate or a $250 million estate. However, in other provinces, this can be an important distinction. There could also be other reasons besides probate fees where we may want to have certain assets not go through probate. And an exception in many cases are private corporation shares, where the corporation agrees that the ability to transfer is there and they recognize the legal authority. And this could be found in most business corporations acts in each province and how that would work. So from here, we'll jump into the transition. Why One of the big issues that come when we're looking at who should take over the business is what I like to call decision paralysis. And this is why many people defer it. In practice, I encountered all 6 of these. For many cases, it's especially a generational thing. It's very difficult to imagine life after work. A lot of clients see their business as a member of the family, and it's hard to say goodbye. They may be workaholics. They may not have hobbies because they put everything into their job. And it's going to be a difficult process to extricate themselves from this. And sometimes, the role of being a professional, be it lawyer, advisor, accountant, or otherwise, sometimes is to moonlight as a life coach and a psychologist with these types of things. But this slows the process down quite a bit. Even if we look at our example of our founder earlier, who is 58 years old, in my experience, I've easily seen 58 become 68, and they're still, mulling over what they're going to do after they sell it. Another big consideration is family dynamics. It's too difficult to decide. This is especially prevalent whenever we're dealing with farms, because farms tend to be very near and dear to the hearts of the family. And in many cases, it's the furthest thing from the desire of the children to take over that farm, but they don't really want to give it up because the land has a lot of underlying value. They don't want to lose the tax attributes of a qualified farming property. They think that there's going to be investment potential later. This happens in all sorts of family businesses, but that complex dynamics come into play. The belief that an owner is irreplaceable is also a very important factor. And honestly, sometimes they are. When we're looking at the value of a business, a lot of times it comes from the goodwill of that owner manager, what they're bringing to the table. Sometimes their connections, their client book is really connected to that personality, and once they're gone, they're gone. Sometimes the clients are of a similar generation, and once they're gone as well. So there is that element of irreplaceability we need to consider. Some think that they're waiting for the big buyout from a big conglomerate who wants to break into their province and buy their business. And I can tell you it happens sometimes. I had a situation in practice where that is indeed what happened. And my clients were bought by a larger company that was looking to expand their footprint into Alberta. This doesn't always happen, but sometimes there'll be decision paralysis and hope that it's coming. A lot of people think there's lots of time to figure it out, but if there's one key thing that you can take away from my presentation when we're coming from planning in a larger scope is we want to think about planned and unplanned departures. So sometimes there's a lot of time to figure it out, but sometimes there's not. And we need to consider when things happen outside of our own schedule, when an age 65 retirement isn't what happens because somebody gets sick, there's a divorce, there's a financial issue. So what do we have going on? What are our planned departure ideas and our unplanned departure ideas? And the other one is just simply that potential successors have no cash. And this is very prevalent when somebody wants someone to take over the business who's half their age, whether that's family, whether that's employees, and they delay the process because they just assume that there's no option other than cashing a check. So what are the 5 common options in this situation? Well, other shareholders, employees, or an employee ownership trust. And I won't bore too much with employee ownership trust. It's a relatively new concept that was mimicked from pre-existing ideas in the United States and Great Britain. However, they tend to be impractical for owner managers because they require a loss of control, independent trustees. They tend to be for larger scale operations, possibly like a larger engineering firm where they don't want to give out shares but want to have the benefit of shares. Competitors are a common option because they know the market and they know what their competition has and whether it's worth trying to acquire. Outsiders, like my example from real life of somebody wanting to enter into the market. And then, of course, family members. But maybe nobody takes over. And this is where it becomes trickier. So maybe our operating company is no longer going to be actively producing income, and it might become a holding company and it becomes an investment holdco over time. In most cases, that's not really anything too spectacular from a corporate law point of view. But if we're dealing with a situation like a professional corporation, we do have to deregister it. So if you have a law corporation, medical corporation, it would be typically the name of the member, professional corporation. So we would need to reconvert that into a numbered company and deregister it. And that would then give us new options potentially to how it's going to be structured. But generally, the difference between an opco and a holdco is its business activities. It's not something you go to the registrar's office and designate. So what would we consider in this sort of situation? This is sort of a non-exhaustive list, but these are all things that I've dealt with in practice, so I'm comfortable going into with some level of detail. We want to think about liability. When we wind up a corporation or amalgamate it, the debts and liabilities transfer to the shareholder if it's a wind up, and to the amalgamated corporation in most cases when it's an amalgamation of businesses. So do we have a situation where there's a potential litigation risk? Did we deal with agricultural, industrial lands where there may be further regulations we want to be mindful of? Are there rental properties? Do we want to keep this separate from the rest of our client's portfolio in the case of any litigation or any sort of underlying risk? Is that a long-term risk? Is that a short-term risk? Something we want to think about. We want to think about asset protection as well for that same similar reason with litigation and with other creditors, mostly with family creditors in this sort of situation, but we should know the client's lay of the land. Privacy is also a very important reason why we may want to keep as a holding company. We want to consider that when we go through probate, if we go through probate, which is likely, we have to disclose all the assets of the individual. Now, we don't disclose corporate assets. We disclose the shares that this person would own. So we might say there's 100 Class A shares of 1, 2, 3, 4, 5, 6 Manitoba Inc., but we wouldn't say that, oh, it also owns some property and it owns some warehouses or it owns some intellectual property that we maybe don't necessarily want or need our estate beneficiaries to know of, other because they may not be the beneficiaries of the corporate shares themselves, for example. U.S. estate tax is another reason we want to consider how U.S. situs assets are being held, whether or not our individual client falls under any thresholds for reporting in the United States, which is currently approximately 60,000 in US situs assets in US dollars, where it triggers a reporting requirement, not necessarily a tax filing requirement. And then whether or not they're high enough that they have to deal with the actual tax itself, whether or not that's going to stay at around 13, 14 million US, if it's going to drop back down to 5 plus inflation or do something else, it's hard to know. But what we do know from a planning point of view is if we can keep our individual holding a Canadian corporation, that might be practical if there are US situs assets within that holding company. And then lastly, we want to consider income splitting opportunities. Do we want to have that corporation holding investments and being able to sprinkle them out as dividends, or being able to grow them, grow the capital for future growth potential, for future allocation potential? Do we have shareholder loans we want to think about? Things of that nature. So when we're looking at investment income, we want to consider that it can still be subject to high corporate tax rates. Depending on what our client situation is, their individual personal income tax rate may be lower than the dividend rate in any given year, depending on how they're being managed. So we want to bear in mind that, we want to think about that carefully. We had a close call with capital gains inclusion rate going up. We had it originally announced as 2/3, then we had it deferred to 2026, and then as recently as last week, we had the current Prime Minister and Liberal candidate announce that he was canceling it. So does that mean it's gone forever? Tough to say. We now know it's in the sightlines. We now know it's something that the government wants to do. It was something that was whispered in hallways and tax firms all over the country for years and years as something that could happen. And we've now seen how the government might do that. So we want to consider that in mind, knowing what the potential could be if the government wanted to shake us down for cash and it wanted to ignore economic realities in this country. So we want to consider that management of income. We want to consider tax efficiency, focusing on capital gains, potentially reduce taxable distributions where possible. But we also want to think about, what does our client actually need to get out of that? Is this a situation where we're managing income in order to maximize OAS, for example? Are there other sources of capital? Are there trusts? So from here, we'll jump into the sale of a business. So generally, it tends to boil down to asset sale versus share sale. Sellers want to sell shares. They want to hand the keys, walk away, cash their check, and enjoy retirement. Buyers want to buy assets. They don't necessarily want to get employees. They don't necessarily want to get the entire burden of the company. They just may want particular things. So how does that shake out usually? Well, this is how a seller sees it. Lifetime capital gains exemption potentially, easier to discard liabilities, and less complexity. It's how a buyer generally sees it. They want their choice. They can avoid liabilities within the company if they're buying only assets. They can pick and choose which employees they may want to keep if there's a company that has employees. They can potentially play around with capital cost allowance and future tax deductions. So in practice, you generally see whichever one the parties are willing to negotiate a better offer on. But sometimes in larger, more sophisticated deals, you may see what's called a hybrid sale, where you may have multiple target co's and acquire co's, and you may have certain things going as an asset sale and certain things going as a share sale in order to maximize the benefit for both buyer and seller. So from here, it's important to note that lifetime capital gains exemption, because that's going to play a very huge part in determining the value of a share sale versus an asset sale. So Budget 2024 sought to raise this to 1.25 million, and we've recently gotten more assurance that this will indeed be the case, regardless of the current political uncertainty in this country. So we can likely assume that 1.25 will be our capital gains exemption for qualified small business corporation shares. Now, in order to get that qualified small business corporation share treatment, we have to pass through a couple tests, which I'll explore next slides. And we may also need to look at, as a result of that, purifying OpCo, which essentially I'll go over as well, but that is essentially making sure that the 90% or more is active business income. So what is a QSBC share? It has to meet all of these conditions. It has to be owned by you, your spouse, or common law partner, partnership in which you are a member. It's be a 24-month or greater ownership period, and it has to be 90% or more of the assets used in an active business. So it's very important for us to be able to do this. It's very important to have this plan in advance for this reason. It's very tricky to be doing a lot of planning in advance of a sale. When we have a sale line in place, it creates risk, it creates issue, it creates complication. So when somebody's looking, like our founder, for example, he was planning to leave at age 65. He was age 58 at the moment. We now have time to look at our corporation, look at what makes sense, how we can make sure it falls under this so that we can maximize our value later. Because this is what a multiplication of a lifetime capital gains can look like in our founder example. So we've got $1 million worth of growth here in the intervening period, but now our founder can sell his qualified small business corporation shares to the buyer, as can the discretionary trust. So is this going to zero out tax here? No, because we've got a $9 million sale, we've got $5 million fair market value. So we've got capital gain on both sides, but we are able to shield a significant amount of that gain. So what would we do to purify? Well, we can distribute non-active assets in order to get to that 90-10. We can use non-active assets to pay down debts, deal with shareholder loans. We can purchase additional active business assets, which may or may not be prudent. But it might be something where there's a unique opportunity, for example, to buy neighboring office space and expand operations in the meantime, with the hope that long-term we can sell for a bit more. We can pay retirement allowances or potentially transferring assets to a holding company. So this last one in particular may not be the wisest thing to do while your client's in a due diligence period with the other side. So this is why it's important to look at it in advance. Here's how it can break down in a more simple situation of how important it is to be able to use this capital gains exemption. So bear in mind, this is lawyer math, so it might be a little bit more complex in real life. The numbers may not be exactly this pretty. However, this shows the underlying trend. Here we have a situation with a different founder selling an incorporated business at the beginning of the month. So we've got 1.499 million capital gain. If we're not able to get the lifetime capital gains exemption on QSBC, we're looking at about $377,000 in tax. Now, if we're able to get that exemption, we're able to greatly reduce what is taxable. So that's quite a substantial amount of savings. So that's why it's important for us to be able to plan in advance. And the cost of that planning is easily saved, as you can see in this example, in almost all cases. I mean, it's illustrative purposes, your mileage may vary, but generally speaking, this is a huge benefit for small business owners when we can have it. From here, we can think about selling our business to our children. The most important takeaway for this is when clients want to sell within the family is they must transact at fair market value unless they like paying tax for nothing. There's a section of the Tax Act called Section 69, Inadequate Consideration, which essentially says when you're transacting with someone who you don't deal with at arm's length, such as children, CRA will reassess that proceed to fair market value. So if it's a gift of $1 million company, you're taxed like you got $1 million in your bank account. So we want to consider that accordingly. We also want to consider what's more common than the gift of a multi-million dollar business is cutting a deal, and cutting a deal by creative valuation. We want to have a realistic valuation because CRA may reassess. So how do we determine that? Best practice is usually to use a chartered business valuator or a CPA who has experience in business valuation to determine a reasonable value point, whether that's tangible assets, growth potential, current revenues, profitability, or reputation, because often that comes into play. But it should be consistent. It should be something that's supportable. We can also look at doing a freeze, as shown earlier, how to get them in. They buy it at nominal value, and then they may potentially have buy out the preferred shares. We call that a wasting freeze in many cases, where the preferred shares are bought out over time, either by the corporation or bought by the shareholders. This is a bit of a word wall here, but it's very important to explain this. So Bill C-208 was a situation that has been many years in the making. It's only become law within the last year, getting royal assent June 20th. But essentially, it's a result of a reality that we found that it was better to sell to a third party than it was to our own family, because of that whole situation of not dealing at arm's length, whether or not there's an income inclusion or not, amongst other issues. So the important thing to take away here is there's two ways for us to do this as a quote unquote genuine intergenerational transfer. It's either an immediate, which we use a 3-year test based on arm's length sales terms, or a gradual, which is a 5 to 10-year test based sort of on the traditional estate freeze, wasting freeze. But again, we need to show real terms, real change of control over periods of time, and a fair market value consideration. Now, it's important to note with a fair market value consideration, it may not necessarily mean that, for example, you sell a business for $1 million and that hits your bank account that week. It may be a combination of cash and promissory note on reasonable commercial terms. And this is something that the legal teams and tax teams can help determine on a case by case. But it has to be something that you would be reasonably foreseeable to happen with a third party buyer as well. So from here, we'll pivot to estate planning for the owner manager and some specific tactics, no matter where you are in the business life cycle. And so we'll start here with a little bit of a word on individual pension plans. So IPPs are employer-sponsored defined benefit pension plans that can be set up by and for a single person. Unlike RSPs, they have to comply with applicable pension legislation, but we want to think about this very carefully, and we want to think about the timeline in which this should come into place. So generally speaking, and again, this may not be a one size fits all. We're looking at when people are in their 40s and when they're in the midst of their income earning potential. That tends to be when IPPs come up a lot. Full disclosure, as a lawyer in practice, I didn't deal with this a lot because this has become something more prevalent in the last few years. But it should be generally considered within the context of a comprehensive financial plan, estate plan, and business succession plan, because we want to figure out how this is going to work, not just from a financial dollars and cents, but again, with that lens of planned and unplanned departure planning. So what are the potential benefits? We may have the ability of tax deductible contributions, use of deductions like income or interest deductibility, whatnot, tax deferred growth, topping up contributions, and pension splitting are some of the potential benefits that come with this. It's important to note that these rules are a bit nuanced, and I am coming at this at a very high level. So it's something that we'll want to evaluate with professionals. The drawbacks, on the other hand, one of the common things in tax planning is that a lot of the things that we can do in order to reduce tax often have set up an ongoing administration costs, because this has to be run every year, then it has to be reviewed actuarially every year. So we need to bear that in mind when we're setting this up. There are deduction limitations. There are requirements to comply strictly with the rules within an IPP when we have them. Doing this does reduce RSP room, so it reduces flexibility on other means. And we have very limited ability to withdraw and to be able to split in a spousal RSP like we would with a normal RSP in planning. So when clients are looking at doing this, it's very important to have a full holistic view on a case by case. Another very important concept in the realm of planning is the unanimous shareholder agreements. Most provinces have this ability: Alberta, Saskatchewan, Manitoba, Ontario. BC's a little special. They don't have this ingrained in their Business Corporations Act, though they have some ways to do this. But this is what I colloquially refer to as a corporate will. It's a specific type of shareholder agreement that regulates the business, binds all the current and subsequent shareholders, and regulates and restricts the powers of a director. Why do I colloquially call this a corporate will? Because it says what happens when the corporation's in trouble, when somebody dies, when somebody's incapacitated, when somebody has an event of marital breakdown, and what that might be. What happens if somebody's seen as being dishonest with the company, if they've acted in a way that's problematic, and how we define those terms. So this is very important for continuity, because this also will help us when dealing with shares of a deceased person. So these things are ironclad. They can be challenged, but generally they're in place until they're amended unanimously by order of the court, or there's one remaining shareholder, because if it's one shareholder, any decision they make is unanimous. So what's generally in these USAs? So they generally have restrictions on transfer and disposition of shares, who can be a shareholder. So this is very important when we're dealing with multiple families, because they may have a handshake agreement that, we can let spouses have these because we want to take advantage of 70 sub 6, but maybe we don't want them to stay. They get their shares indefeasibly, and then maybe we buy them out. So it's what we call a roll and redeem strategy. Maybe we don't want any kids at all. Maybe we don't want to deal with certain people. So other shareholders have the ability to reject a sale or reject a transfer. We may have a situation where key control issues are still within this USA. And this is one we need to tread carefully on if there's a trust involved, because the question then becomes, is there somebody who can exert control on a trust through a related document? So that can be something we need to think about on a case-by-case basis, but this is more popular where we have a situation where, let's say, mom and dad are selling the business, and we want to make sure that their kids don't completely destroy the business they spent decades creating. So they may have, with their preferred shares, so long as they're in place, the ability to veto certain decisions. We might have a kind-hearted buy-sell, like a right of first refusal, where we have the ability to match the purchase from somebody else, or we may have a not-so-friendly one, which we call a shotgun. Shotgun clause essentially says, I buy you out at a value, or you buy me out at that same value. So the idea being 2 people enter, 1 leave. This will also generally have provision on how insurance is put on key personnel, how the insurance is used, and what we do with any excess. If, for example, we had insurance on a key person for the idea that we were going to redeem their shares at death, but perhaps there was an option to hold those shares instead for the next generation. Maybe they were able to take on those. Maybe it went to a spouse and it was fine to have that, but we have this insurance proceed. How is that going to work? We might have requirements to sell or repurchase in the case of, as I mentioned, death, incapacity, disagreement in conduct, divorce, things of those natures. And insolvency is also a very popular one. And we get to define the terms on that. Is it 100% of fair market value, and how fair market value might be determined, be that CBV or other means? Might it be a reduced fair market value, for example, in the event of divorce or insolvency, that might create a burden on the ongoing operations of the business to redeem? So there may be a penalty for that. I've seen that be as low as 70, 75% in practice. Often I've seen it at 80, 90%, but sometimes it depends on what the needs of the shareholders and the business are. We might have provisions on arbitration, how we solve disputes. Do we march straight to the court, angry, red-faced, and wait 5 years for justice, or do we have another way to get through these problems? And how do we handle sensitive and confidential information upon maybe leaving the business, or while they're acting on the business? Who has access to that? That might also be in a USA. So just to dig in a little bit more on death or disability shareholder provisions, they often provide the process on how the deceased or incapacitated shares can be bought by surviving shareholders, repurchased by the corporation, or allowed to be transferred to the estate beneficiary. This can be done, as I mentioned, to avoid the business relationship issues between heirs and surviving shareholders, because we may not want to deal with that. There may be an idea that we consolidate in the last one and they wind up, or whatever the partners of this business may have in mind. So this is often structured in either what we call a cross purchase or share repurchase. But we want to be really careful how this is done. And this is why it's really important to look at it as a separate document from a will, but to still make sure that the two speak together, which I'll go into a little bit more detail, because we want to make sure we don't inadvertently ruin the spousal rollover. Spousal rollover 70 sub 6 in a nutshell is that when we transfer to a spouse or spouse trust, the assets must vest indefeasibly in that spouse or spouse trust within 36 months. So if we have an automatic repurchase, if we have a situation where it sits in escrow for 5 years or some weird sort of provision, that might make it taxable on the terminal return on the estate. So we need to be or the taxpayer rather. So we need to be very mindful of this. And again, this is where life insurance may come in, and this is where it might be governed. So as mentioned, we want to look at it as two separate documents, an estate for personal matters, your will, and you have your USA, your corporate matters, governing how the shares are dealt with. So we want to be really mindful not to attempt to govern corporate assets through wills or EPAs, because we want to avoid overreach. As mentioned, a will should only reference what is personally held. So when we go back to what I was saying before about privacy, that's where the USA comes in. That's where USA corporate documents will discuss what we do with assets within the corporation. We don't make that a public knowledge. We also want to avoid the situation where somebody is willing out corporate assets, because how that is often seen for tax purposes is that it's seen that the corporation had to have given that property to the estate to then roll out under the will. That means in most cases, we have a dividend. So we may have an extra 41-ish% tax on that we didn't anticipate. We also may have a situation where the other shareholders go, whoa, you didn't have the power to do that. And we now may create an oppression or derivative action against the corporation. So we want to be very mindful of this. Some significant adverse consequences if we don't make sure the two documents work together. These are also very helpful when we're looking at family property. If I had $1 for every time a client asked if they could use a USA instead of a prenup, I'd be talking to you from the beach somewhere in the Caribbean. However, that's not what these things are intended to do, but they do provide an opportunity to limit recourse or rights that a person may have in the event of a marriage or relationship breakdown. Why? Because they can define when that breakdown is. They can define the value of that property if it's pre-existing and not set up as an attempt in the last minute to defray the rights of a spousal creditor. So for example, in the event of a marital breakdown event as determined by the USA, it may trigger liquidation of those shares at a penalty. So perhaps it's 80% fair market value. Now that 80% fair market value is what is subject, and the person who is seeking a claim is not able to get the direct shares. Now, that's the idea. Now, could a court conceivably rip that up? Absolutely, there's a risk in that. So it's not a substitute, it's defense. But it is a useful tool for business continuity and a useful way to make sure that the business can proceed without being dragged into these sorts of matters. So in many cases, the will is the shares are the most valuable asset of the estate. And so the will needs to be drafted considering that the primary asset are private corporation shares. And it's important to remember that the will governs these shares, not the property with the corporation. And it's important to note that in many cases where shares are subject to a USA, or even if there's other corporate documentation of relevance, that the will is aware of that and the will is not actively contradicting that, or that there's adequate language to put an executor's attention to it. For example, in many of the wills I did in practice for owner-manager clients, there would be a specific unanimous shareholder provision that said very clearly how we deal with those shares and what they need to be mindful of. In some cases, even what sections of the USA they probably need to read to understand what's going on. because a corporation is a separate legal entity. However, your executor inherits requirements. They have to safeguard assets of the estate. They have to safeguard shares. In many cases, that might be becoming a director of the corporation. And there might be rules on how to be a director of the corporation because of the USA. So this means we need to consider that executor very carefully. It's often the scarlet letter in some families to be the executor of a complex estate. So it may not necessarily be the default, hey, let's appoint our spouse and then our 5 kids jointly and severally so they can make decisions that they contradict and hate each other over. It may be a professional. Because it is a highly demanding and time-consuming responsibility. It may be a trust company, and it may be worth spending 2 to 4% of the value of the estate to have that professional in place. That's going to be very situation specific, but the key thing is very important to consider that executor. Very similar for a power of attorney. Power of attorney regulates when you're either incapacitated or given the ability for someone to act on behalf. So there's 2 types generally in Manitoba as well as in Alberta, Saskatchewan, Ontario, BC. Immediate or springing. Immediate is as soon as it's signed, it's in place, and it can be revoked if there's capacity, and it may endure or continue depending on the province, notwithstanding incapacity, depending on the terms. The other more popular one that you see with most clients is a springing. It comes into effect on a future event that is generally defined within the document, though if it's not defined in the document, Powers of Attorney Act in various provinces do have activation suggestions. But typically it's infirmity by 2 medical practitioners declaration. Ideally, one who knows the client and one who doesn't, because if they both say that, they're probably right. But there may be other contingencies defined in the agreement. Where it's important for owner managers is this person may be acting as them for their shares for an indefinite period of time. A lot of people have a fantasy where an enduring power of attorney may come into place 6 months before they pass away peacefully at the age of 102. That would be nice. It certainly happens, but in my experience, a power of attorney can be activated in your 30s and your 40s, and it may persist for decades. So we need to be considering who is able to act. We also need to make sure that proper language is in place in these powers of attorney for them to be able to act on a business and potentially engage in tax planning, including the estate freezes that I showed earlier in this presentation. But here's the problem. Courts generally see what an attorney does for the donor or the grantor, depending on province, as a fiduciary duty to that donor or grantor only. And estate planning and tax planning is generally not seen as acting in their best interest. It's seen as acting in the best interest of the eventual estate or the estate beneficiaries. So generally, courts will suggest that there's specific powers to be able to engage in tax planning in order to overcome that hurdle, so that they can see that it was clearly contemplated, that ideally there was legal advice given on why that's in place, so that we are able to engage in tax planning. Because again, we want to think about planned departures and unplanned departures. Can we do this if somebody gets sick at age 50 and we thought we were going to be retiring at 65? Do we have the ability to do some tax planning to be able to prepare for a sale? Can we sell the underlying property properly? And so you want to make sure that you have proper appointees in these documents who are reliable, good project managers who can do this for a period of time, or failing that, if they're unable to act, if there's somebody who's appointed as an alternate who can act in that case. That can be variable by province, how that's done. So important to talk to a lawyer on that. But we want to have that continuity, because if a power of attorney has no named attorney who can act, it's gone. And that means we're through the court process generally. And that can be very problematic, where unlike a will, where if the executors are gone, we can potentially have an administrator appointed by the courts to administrate that will. We call that a grant of administration with will annexed. So we want to be very mindful of that. And when clients are thinking about their powers of attorney for their business, they also need to be mindful of their personal matters as well. So they should probably look at having healthcare directives or personal directives, advanced directives, or whatever that respective province refers to them as. So to sum up, Proper succession plan needs to consist of both proper corporate structures for the business as well as proper personal documentation. That also we want to be thinking of in advance of potential sales, how that will look before and after. So this doesn't mean that a 25, 30-year-old client starting off with a business needs a $50,000 massive tax plan, but they should have something that can grow with them. It doesn't need to be complex, but it should consider that planned and unplanned departure planning. When we do this right, as shown throughout the presentation, there can be significant tax savings, including if we're in BC and Ontario, for example, probate savings, or if we're in Alberta and have property in BC and maybe movement between BC and Alberta, or in Manitoba, there's maybe cabin or cottage in Kenora that's being used a lot. Have we mapped out the ability to ensure that we're not paying full BC or Ontario probate? Are we maximizing between the provinces? Is there planning for that? Do we have plans in place to be able to pay for taxes in the event of an unplanned exit? Do we have that structuring and a power of attorney to do some of that fund transition planning that we went through earlier in the presentation? Because when we do this right, we definitely are able to reduce reasonably foreseeable litigation and administrative delays. I had spent a lot of time in practice as a litigation advisor for litigators sitting second chair in these cases, and I can tell you almost everything I saw was avoidable. So this is where proper planning comes into place, and it's proper planning not at the last minute. It's got to be done in advance. As shown earlier in the presentation, there are reasons for that. There's 24-month testing periods for holding shares. There's periods we want to be mindful of to confirm that something was not done to defray a creditor. But if we have these plans in place and they're consistent, they're before known issues, they're able to prevent a lot of delays. So that's what I have for you today. And we can open it up to any questions that we may have.
That was great. Thank you so much, Matt. I know there was certainly a lot of information there, and just so everyone is on the same page, this will be recorded so that you can go back and watch it afterwards. I'll be sending out an email where you can find that link after the fact. There were some questions that came in, so I wrote them down. Kind of read them one by one here. So how do you typically walk people through deciding what to do with their business rather than waiting for the big sale to come? And I guess paraphrasing, the second part of the question was kind of like, at what point do you recommend transitioning to a holdco or having all that preparation in place?
So this is a really great question. So I found in practice, just getting to know your client and knowing their quirks, right? But generally, it kind of comes around to, do you have a 1-year plan, a 5-year plan, a 10-year plan? So when I sat down with clients for estate planning, for example, I would usually tell them we're planning for 3 contingencies in a 5-year plan and see how they reacted. Those 3 contingencies were, we're back in 5 years, we're making tweaks to your corporate and estate plans. 2, one or both of you are dead and we're acting on that plan. Does it work the way we think it's going to work? And the third one is the most sinister of the bunch, which is one or both of you are incapacitated. We're stuck with what you have. Your documents are locked in. Do we feel comfortable how we can pivot? And so that kind of feeds into the second part of the question of when do we look at converting to holdco? That's going to be a lot of what's the client's plan. So generally the sweet spot for that tends to be in their 60s, because once we start hitting 70, 71 specifically, we're now thinking about RSPs becoming RIFs. So we have to think about all their income sources altogether, what the business prospects are, because nobody will know this better than our clients. And sometimes it's hard for them to be introspective, but what is the future of their business? Is it something that AI is coming for them? Is it something where it's only as good as their own inertia? And what is their real inertia? So it's a lot of active question asking and active listening to kind of dig deep and to kind of break down any trust barriers a client may have, because sometimes they have pre-rehearsed answers and we have to sort of, get past that surface layer and find out what they're really thinking. And the best way we can do that is to make sure they feel that they can trust us.
That's great. Great advice, and hopefully answers that question there. Next question, can you explain a little bit about how a trust gets set up, who to speak to, whether it's a lawyer, your financial advisor, like our team, a tax accountant, something like that?
Yeah, so trusts are generally settled by lawyers. but it doesn't necessarily mean that the lawyer is giving all the instruction advice on how it's constructed. So I've had a lot of times in practice where the tax accountants created a tax plan and then they ran it by us and we refined what their ideas were and created the trust. So generally, if a client looks like they want to do that, it's a conversation with their tax accountant for a couple different reasons. One being it's about to very much complicate their tax filings because they're now going to have T3s, Schedule 15s, and additional costs behind that. And we want to have an active run at numbers. And that doesn't mean that financial advisors are off the hook. Because financial advisors are generally the quarterbacks of these clients. You have the most touch points. Um, so it can be asking some probing questions about what the ideas are with succession, how they want to be able to run things, and to be able to kind of get an idea of what the client see the pros and cons of a trust setup would be.
Okay. Yeah, that's a great response, and I think adds some value there. A couple of questions left. So one was that came in similar to the last question. Who do you talk to go about purification of the business as well as operating, to do an opco?
So it's one of those things where lawyers ultimately set these things up. But it's often the accountants that are doing the filings and the forms. Like I can tell you from practice as a tax lawyer, I filed only the forms that the accountants didn't want to file. So, dicey T2057s on 85 rollovers, or when we were trying to move resource property to Americans, and the accountants didn't want to touch that, and I had to do the soft story. Um, so it's one of those things where everybody kind of has a role. Clients hate hearing that, but unfortunately, it's one of those things where, all three of your team of experts probably have a role in it. With purification, sometimes it's nothing, anything more than paying off a shareholder loan, and that might be an internal thing that an accountant figures out. But anything generally in a corporation or a trust, you want to document for a couple reasons. You want to make sure it's documented in case CRA comes calling and asks some questions, but you also want to make sure it's documented if your shareholders, directors, beneficiaries come knocking, and you want to show you acted in good faith. This is generally done through resolutions, or in the case of trusts, maybe resolutions, but it might be meeting minutes, trustee minutes as well. So that's where the lawyers come in, because you want to have a well-maintained minute book or trust book to support what we did in those processes. Because we may file, but if CRA asks for more, having that ability to show what we papered goes a very long way to make that audit monster go away fast.
Okay, great. And the last question here, Mike, you can feel free to chime in on this as well. Relates to IPPs, whether all financial advisors set that up, whether it's something that we're able to do on our team, and kind of what that looks like once that does get set up.
So, Mike, did you want to go? I'll just say before Mike, you take over. But before
I
he
was looking
does,
for my, I was trying to unmute
generally
myself there for a
lawyers
second.
don't
Go ahead.
generally set these up. It's usually they're done more with accountants and financial advisors. But I'll let Mike go from there.
Yeah, I mean, yeah, generally speaking, it all starts with the conversation. We deal with clients, Matt, as you had mentioned, we start talking to clients in their sort of mid 40s and start going through the benefits, the pros, the cons of when it makes sense to open up or set up an IPP. We do go through that process, but at the end of the day, it's like you said, it's a three-headed approach. We talk to the accountant, we talk to the lawyer, and then we have our own input. And then we have a meeting with all three professionals and the business owner and see if it makes sense for their specific situation. A lot of times it does, but it doesn't always. So that's sort of our approach.
That's great. Well, thank you, Mike. Thank you, Matt. Thank you, everyone, for who listened in today. I think this is very informative. Like I said, if this was a lot of information to take in at once, you can certainly watch the replay. I'll send out an email with that link. Matt, do you have anything else you'd like to add? People, where they can find you if they have questions?
So I'll just say, really was great being here and being able to talk about all these things. So if you work through your CI wholesaler, you'll have access to our tax retirement estate planning team. And we're able to field a lot of these sort of information commentary type questions, although as much as I love to go jump over the boards and give legal advice, I definitely can't do that anymore. So anything aside from that, we're here to help. Important thing I'll just re-sum up is, plan ahead, use your team of experts. Like Mike said, we work better when we all are working together. There's things lawyers don't do, shouldn't do, and it goes for all the team of experts. So make sure that those are leveraged.
Great.
I
Thank
agree.
you so much again for your time, and hope everyone has a great day.
Thank
Thanks
you.
a lot,
Take care.
everyone. Thank you, Matt. Take care.